Hi, Sarah, and this morning I do have a special guest. David Stockman needs no introduction. David, thank you for taking the time at this very important intersection of central bankers and global economy. Thank you.
Glad to be here.
All right, David, when I was listening to the Janet Yellen press conference last week, there were issues regarding the richness or cheapness of the equity markets, and I believe that Janet Yellen's exact words were on the high side. Can you give me your impression of whether stocks are rich or cheap?
Well, I would say they are way on the high side. Look at the biotech sector this morning, NASDAQ Biotech, 150 companies. They're still trading after the correction at $1 trillion worth of collective value. They had $20 billion worth of income or profit reported to the SEC in the year just ended. That's 50 times. If you take out the 4 or 5 big cap biotechs, you have something even more fantastic. You have $280 billion worth of market cap for the 125 biotechs, other than the large ones, that have $10 billion of negative earnings and virtually no revenue. Now, I would say that's a bubble. I would say that's irrational exuberance if we ever had it. Or look at the Russell. It's trading this morning, notwithstanding a little bit of correction, at 89 times the actual SEC reported earnings of those 2,000 mid-cap and small-cap companies in the United States. Or even take the whole New York Stock Exchange. The median company today is trading at 22 times earnings for those that have positive earnings, the highest that we've had in history, and even higher than 2008 or the dot-com bubble in the year 2000. So
now, David, let me stop you there, though. Let me stop you there, okay? I get hundreds and hundreds of emails a day with very good Wall Street-type research. I don't see it. So what numbers are you looking at to find this extra richness that Wall Street seems to be overlooking?
Well, I think we have a divide between the GAAP honest numbers that are reported to the SEC.
Okay, now hold on. So viewers understand. Let me interrupt you. GAAP being the generally accepted accounting principles. Okay, right. Continue.
And signed off by the CEO and by the CFO as being accurate and honest on penalty of jail time. Those are the real earnings.
Where does that paperwork go? Where does that paperwork go?
That's what's in the 10Ks, the 10Qs. That's what's reported
to the SEC.
To the SEC, and that's what the Wall Street sell-side analysts say totally ignore. We have a better answer. It's called forward hockey stick X-item earnings that exclude any kind of write-down, any kind of so-called non-recurring event that obviously lowers the earnings. So let me.
Well, that sounds honest to me, unless those reoccurrences reoccur too often. Is that the case?
The fact is they reoccur quarter after quarter. I looked at the S&P 500 for 7 years, from 2007 to 2014. The earnings of all companies combined reported to the SEC were about $5 trillion. The earnings that the street said you should look at, X items, were $6 trillion. Now, I would say $1 trillion worth of difference is a difference, and it fundamentally affects valuation. Beyond that...
Well, listen, we're going to have to stop it there, David, because I'm on a hard break. I am definitely going to have you back. I want to hear part 2 and part 3 to this story. It seems like some of these numbers obviously have multiple interpretations. Thank you so much, David. Sarah, back to you.